Hello and welcome to our Executive Women in Agriculture webinar. We are glad that you've joined us. My name is Julie Deering and I'm the Managing Editor for Top Producer Magazine. Today, Paul Neiffer is going to share his expertise with us. Paul is a CPA and business advisor specializing in income tax and accounting services related to farmers and processors. Paul is also one of our top producer columnists and writes the Farm CPA. With that, I'll turn it over to Paul.
Thank you, Julie, and thank you everyone for attending the webinar. Today we're going to cover two primary topics. We're going to discuss whether a farmer should invest more money into paying additional self-employment or FICA taxes in order to increase their Social Security return when they retire. And then at the end we're going to go over year-end tax planning as far as crop insurance, some estate stuff, and just normal year-end tax planning. And we're going to get started here with the next slide. And on Social Security investments, you know, the key thing as farmers, I get this question, I won't say fairly often, but it does come up. We've done a good job for the last 20 or 30 years with farmers of keeping their income fairly low. Matter of fact, a lot of farmers over the last 30 years, it really wasn't until the last 1 or 2 or maybe 3 years where they've actually paid much money into Social Security, and they're coming into us and they're saying, should I go out there and really pump up my income in order to get more money into my retirement when I start collecting Social Security? So we're going to go over that. And first, we're going to go over some of our Social Security resources. The primary one I think is a great resource for everybody out there is the Social Security website. It's located at www.ssa.gov. And I would suggest going on there, and I think it's in the upper left-hand corner of the website, is a thing called My Social Security. And when you go there, you click on that, and it's going to allow you to sign up to get a benefit statement online, and that's the thing they used to send in the mail, and they're not doing that anymore. So you need to go online and be able to access this. It's fairly easy to sign up. I signed up about 9 months ago, and it essentially asks for your full name, your date of birth, your Social Security number, and then there's 3 security questions that they ask just in case you forget what your password or username is. And that's about it. It actually isn't one of those things where you got to wait in the mail to get something like when you deal with the IRS. So it's very good. This is a key document that you need because it's going to tell you what your earnings have been over the last, well, since you started working. It's going to give you an estimate based on those earnings how much your monthly Social Security benefit is going to be when you retire at full retirement age, if you retire early at age 62. And I think it also tells you what your maximum benefit would be if you wait till age 70. The other thing, you need to look at those numbers because I have seen the Social Security will make a mistake on how much income that they pick up as your earned income. They're getting those numbers from the IRS, and sometimes they do not know how to interpret those numbers. Some cases it helps the client or the taxpayer. Other cases it doesn't. And then in order to determine your retirement benefits, we have a couple steps that we do. We take the highest 35 years of your inflation indexed earnings, and what that means is we take all your earnings since you started your career, and there's an index number based on inflation, and we multiply by that number. So for example, let's say you started working in 1972 and you earned $10,000. That inflation index number for 1972 might be, let's say, 4. 10,000 times 4 is 40,000. That's the number you get credit for. And then after we determine those numbers, we then divide that by 35 years, and we sort of put that in the resulting number into what we call 3 tiers. And our first tier is if that number is between 0 and $9,492 on an annual basis, you get the benefit of that number times 90%. So if you were at that top end of $9,492 times 90%, that would say that your annual Social Security benefit would be approximately $8,500. Now, if you're over the 9492, from 9492 to $57,218, whatever is in that tier or bucket only gets a benefit of 32%. So in this case, if you've got roughly 46,000 times 32%, that might be 13,000 of annual Social Security benefits. Now the last tier, that's the worst tier, and if you have money in that tier or an average monthly earnings in that tier, whatever is in that tier only gets valued at 15%. So as you can see, Tier 1 is about 3 times more valuable than Tier 2, and Tier 1 is about 6 times more valuable than Tier 3, and Tier 2 is about twice as valuable as Tier 3. And this is what we're going to go through some examples in the next slides as to how this is calculated. And then our last examples are going to go through what your payback period, how long it's going to take you to recoup your investment, whether you're in Tier 1, Tier 2, or Tier 3. Some other things, full retirement age for most people right now, although it's scheduled to increase to 67 years, it's actually at 66 years now. You can retire early at 62, but there's a reduction in your benefits. You can delay until age 70, and the nice thing about that is if a lot of our farmers are still working up to age 70 or beyond, is that your retirement will go up by an increase of 8% per year. But like I said earlier on, at age 70, that's when that increase stops. So there's no reason to delay beyond age 70. If you have a spouse that really has not generated much earnings during his or her career, they're allowed to collect 50% of the primary earner or primary insured or their own amount, whichever is greater. And we're going to go through some examples here to show you how this sort of works, which will be a little bit later on. One benefit that you might take a look at is the primary, we sort of call it file and suspend, and how that works is the primary, and when we say primary, that's the one that has the greatest amount of earnings. The primary is going to apply for Social Security at age 66 or whatever their full retirement age is. And like I say, it's scheduled for those that I think are born in 1960 and later. It's 67 is the full retirement age. But whatever your full retirement age is, you can file for benefits, but then you're going to suspend the benefits. And people say, well, why would you do that? Because you're filing, but you're not collecting. The reason we do that is it allows the spouse to draw 50% of the full benefit instead of, and that way they're allowed to collect their 50%, and then when you wait until age 70, you can collect a much greater amount. Another thing to remember is that Medicare is based on age 65. It has not been extended yet. You start collecting or start paying into Medicare at age 65. And one thing about disability benefits, people need to have earnings and they need to have 40 quarters or basically 10 years of earnings in order to qualify. And Julie will be accumulating your questions, and we'll have a question and answer period here in about another 10 or 15 minutes. Okay, so we'll go through this a little bit more detail. What we have to do, and we have a little earnings calculator that we have, but you take the top 35 earning years, or 420 months. These are all indexed for inflation, so you would enter, let's say you had a $30,000 earnings in 1997, and that index factor was 3, or let's say it was 2, that's the equivalent of $80,000 in today's money. For 2013, the maximum earnings that we can use in this calculation is $113,700. For 2014, they just came out, and I guess it was appropriate they came out with some of these numbers. I think it was on Halloween Day. But the new number for 2014 is $117,000. And when we And what I'm going to be showing from here on out is a monthly number because it's easier to know what your monthly income is going to be instead of annual. So I've taken that annual number and converted it to a monthly number. So what we have to do is we have to calculate whether you're in Tier 1. If you're in Tier 1, those are valued at 90%. For those earnings, which would be from $792 to $3,977, or basically, actually from the start of 791.01, that's valued at 32%. And then Tier 3 is everything above that, valued at 15%. And you got to remember that these are indexed to inflation, and 2012 has basically got a factor of 1 for purposes of calculations I'm doing here. Okay. So what we're going to do is we're going to show 3 examples. We're going to determine the estimated benefit at full retirement, and the key is full retirement, because that's getting your maximum benefit here, based on a sample farmer with 3 levels of earnings. So we're going to go to the first one. Okay, so in our first example, we got Farmer Bean. He's been a farmer for almost 50 years. He's been paying into the system for 50 years, but he's had a pretty good CPA, or he just didn't like paying taxes, so he really has not paid in much into Social Security. So when he decides to retire at age 67, we could assume 66, but full retirement age, he adds up all of his 35 highest years of indexed earnings, and we're calling that AIME, so that acronym will be shown here several times. We come up with an AIME of $675. Since this number is less than $791, we now multiply, oops, I see I already have an error, sorry guys. We multiply the $675 times 90%. That 711.90 is taking 791 times 90. I'm sorry about that, but we take 675 times 90%, and that's going to be roughly $610 per month. So this farmer, he's still in Tier 1. We only apply 90% to those earnings, and we come up with a monthly benefit of about $610. Now let's assume that Farmer Bean's AIME amount is now $2,750 instead of $675. So in this case, he's all the way into Tier 2. So we value the first $791 at 90%, or that $711.90. The remaining $1,959 is valued at 32%, or $628,688. You add those two amounts together, and in retirement, in the first year when he retires, he's going to get $1,338.78 per month. You know, as you can see, even though earnings in Tier 2 are about 2.5 times higher than Tier 1, your benefit for Tier 2 is actually less than your Tier 1 benefit. Okay, then our final example here, let's assume that Farmer Bean has been paying a lot of Social Security tax over the years, and his average index monthly earning is $7,500. In this case, we go through the number crunching, and we come up with a monthly benefit of almost $2,400. And as you can see, Tier 3 is only worth about 1/5 of Tier 1 and about 1/3 of Tier 2, even though Tier 3 is almost 4 times higher than Tier 1. It's about 3.5 times higher. Okay, so that's how your monthly, it's called the PIA, primary indexed amount. That's your monthly benefit that you're going to get. That's how we calculate it. Now what we want to do is we want to take some examples of what is your return if you invest additional Social Security tax into either Tier 1, Tier 2, or Tier 3, and in a simplified basis, what is your payback period? You know, is it going to take you 5 years to recover your investment? Is it going to take you 10 years to recover your investment? Is it going to take 50 years? That's what we're going to calculate. Okay, here we're going to, in each case, we're going to invest $10,000 into additional FICA tax on your tax return. And that's equivalent of about $80,000 of earnings. So in this case, if we invest $10,000, in each case we're going to increase our average index monthly earnings by $192. If you're in Tier 1, you're actually going to increase your monthly take-home pay from Social Security by roughly $173. You've invested $10,000, you divide that by 173, and it takes you about 58 months to get your money back. That's a little bit less than a 5-year return. Not too bad. Now, the other nice thing is if you have a spouse that really hasn't been working enough or doesn't have a very high AIME, that person is also entitled to 50% of that number. So if you add that together, we come up with, if we take your benefit plus your spouse, it now drops that payback period from 58 months down to 38 months. Now, in our assumptions here, we're not taking into account time value of money of investing the $10,000. If you got to wait 5 years, there's a little bit of an extra cost there. But we're also not taking into account that Social Security is also indexed with inflation, which would tend to offset that a little bit. We're just showing a simple example here. Okay. Tier 2. Again, we raised our average index monthly earnings by that $192. However, you got to remember in Tier 2, we only get 30% of that number. Let's go back to Tier 1. You notice we get $172.81, $192 times 90%. We're now in Tier 2. That $192 only gains us an extra $61.44 of monthly benefits when we retire. So now instead of taking 58 months to get our money back, it's taking us 163 months, which is about 13 and a half years to have a full payback. So what that's saying, for you to invest $10,000 in 2013 and retire in 2014, you got to wait 13 and a half years to get your money back. That may or may not be a good investment. If you think you're going to live for 40 years after retirement, it's probably a pretty good investment. You know, if you're in poorer health, it is probably not worth making that investment. Now, if you factor in your wife's or the spouse's benefit, could be the husband, it does drop your payback period from 163 months down to exactly 108 months, which is 9 years. And I've shown you the math there on how to arrive at those payback periods. Now let's go on to the really, in my opinion, the worst investment. Okay, now we have a farmer. It's similar to Farmer Bean, who was in, you know, he already had a monthly average index earnings of about $7,500. He wants to pump up his Social Security income, so he invests another $10,000. This case, he's going to increase his monthly retirement by a whopping $28.80. So it's going to take 347 months or 29 years to have a full payback. And then if you incorporate the spouse's benefit, if that's applicable, you're looking at about a 19-year payback. My bottom line recommendations, for me, if you do your calculation and you're the primary person that's getting ready to retire, if you're still in Tier 1, unless you're really in poor health, I think investing money into Tier 1 is an extremely good investment. You know, anytime you can get a payback, especially with the spouse's benefit, anytime you can get that payback, a full payback in under 4 years, that's really a pretty good investment. If you're in Tier 2, I'm probably neutral to slightly biased against making that investment, especially if your spouse already has other earnings that gets her up above that 50% number. If it's just relying on yours, if we go back to Tier 2, you know, if you retire at age 66, you got to live for sure until age 80 to get your money back. After age 80, you might start getting a return. And again, with inflation, you might get a little bit better than that. But that's, you know, I'm not sure if that's a great investment or not. Tier 3, in my opinion, unless you think you're going to live for 50 years to 115 or 105, I don't really see where investing a lot more additional money in Tier 3 makes a lot of sense. I just don't see the payback on that. Here's a little chart. Again, it's just showing that the blue, the chart on the left shows that it takes you about if it's just strictly the farmer, no spouse, it takes a little less than 5 years. If you're in Tier 2, it takes about 13.5 years. And then you notice the red, Tier 3 takes almost 30 years. And then if you got the farmer with the spouse, it drops down. But again, to me, Tier 3 is taking, at a minimum, almost 20 years to get your payback. So I just don't see where it makes sense to invest into, Tier 3, maybe Tier 2, definitely Tier 1. And with that, I've been talking for about 20 minutes. I'm going to open it up to questions, and I think, if I remember right, is Julie's going to be asking the questions, so I'm ready for some questions, Julie.
Great, thanks, Paul. If you have questions, please type them into the chat box, and I will ask them for you. That way we don't get a lot of feedback in our lines here. While we're waiting for a question to come in, Paul, I just have one for you.
Okay.
In planning their investments, where do people get hung up the most, or where do you see most mistakes made?
In regards to Social Security?
Yes.
I think where they get hung up is, because I've had a lot of clients and or people I talk to at some of the seminars, they know they haven't paid in much, and they think if they start paying in a lot of money now, it's going to be a great investment for them. And it just, like we sort of went through on the charts and the examples here, if you're into Tier 2 or Tier 3, it's not a real good investment. I mean, Tier 2 might be okay. Tier 3 is horrible.
Okay. I am not seeing any questions, so I think you're okay to continue on.
Okay. Well, I might, just because I know we're going to have a little bit of time here, I thought I might just share a couple numbers here just to give you an idea how much value Social Security can be. If we have a farmer that's in that higher Tier 3 level, they've already made the investment. If they end up with a monthly benefit of about $2,300, and it grows at an average of about 2.8% with your cost of living, over a 10-year period, that farmer or farmer and the spouse is going to end up with $320,000. A 20-year period is $740,000. And a lot of people, at age 66, a lot of people, my mother-in-law is turning 94. A lot of people are going to live another 30 years, and that's $1.3 million. Just as a personal example, my parents were older when I was born. I'm the oldest of 3 kids. My father was 46 when he was married, 47 when I was born. When he hit retirement age and started retiring, us kids, there was 3 of us, we were entitled to a monthly benefit, and if my memory's right, it was about $300 each, so it was almost $1,000, and this is a long time ago. Well, not that long, but it's 30, 35 years ago. That's the equivalent of probably $800 a month right now. And we collected that while we were going through college. So we collected that for I think I collected it for almost 6 years. And, that adds up to being a pretty good sized benefit. Another maybe, there's a lot of talk about Social Security going broke. They came out with a release, I think, a week or 2 ago showing that Social Security will start taking in less money than they pay out in about the year 2030 or so. But I think it'll still be around. It's just that there will probably be some changes on the age. But for most of the farmers now nearing retirement age, that's not going to change. So let me go on to the next section. Okay, we're going to go over and hopefully get some questions at the end. We're going to go over some year-end tax planning, some crop insurance planning, because I believe we won't have as many claims as last year, but we're certainly going to have some claims. And then we'll probably go over a little bit of succession planning. I have slides on this. If we still have time, after the questions, I may explore a little bit more, but we'll see what our time looks like. Okay, back at the end of last year, the beginning of this year, which affects this year's tax returns, we had some major tax rate changes. Up until 2013, our top tax bracket for federal returns was 35%. We've now added a new tax bracket. Excuse me. We now have a 39.6% bracket, so that's almost a full 5 percentage points higher than the old one. And it's applicable when you have taxable income if you're a married filing joint of $450,000, head of households $425,000, single taxpayers are $400,000, married filing separate is $225,000. And I can tell you over the last couple years, I would say until 5 years ago, we didn't have a lot of farmers over $450,000, but over the last several years, we've had many farmers, even with all the deferment options that they have available, have gone over that level. So this is going to start applying to some of our farmers. This is indexed to inflation. The 2014 number came out about a week ago, and it's about 1.5% higher. I think my memory is on the married filing joint, it starts applying at $457,600. It's somewhere in that ballpark. One little quirk is if you're single, your 35% tax bracket is only about $1,600 big. So you go from 33% all the way, I think it's 33%, all the way up to almost 40% in less than $2,000 of income. And then one nice thing, back in 1986, this is how long this AMT exemption mess has been going on. They made a lot of dramatic changes to the alternative minimum tax, and what it required Congress to do either every year, every other year, or maybe every third year is to do what's called an AMT patch. And what all that meant was that when they passed the changes clear back in 1986/87, they had given everybody a pretty good size standard deduction for AMT back then. So most taxpayers, if they made the equivalent of $100,000 or less, were not going to be subject to AMT. Well, they never indexed it to inflation. So lo and behold, starting about 10 years ago, it started applying potentially to more and more people. The interesting fact is that if they had not passed this new law this year and just let AMT go back to the old rules, approximately 30 million taxpayers would have been subject to AMT. And most cases, it's currently about 4 million. So you're going to have 7 times more taxpayers subject to a new tax, and Congress didn't like that. So it's now been made permanent, indexed to inflation. Those are the amounts for 2013, and 2014 again is about 1.5% higher. Here's the one that's going to start applying to a lot of our farmers, especially if they are cash renting their ground, if they are a landlord. We now have a new, although it's been around since 2010, it just started applying this year. We have a new 3.8% net investment income tax. It applies to interest, dividends, annuities, passive income, but the key one for our farmers are rents. And it's sort of got 2 calculations. First, you have to figure out what your net investment income is. And then secondly, you have to figure out what is your adjusted gross income less a threshold amount. And for singles, it's $200,000. For married couples, it's $250,000. So you determine those 2 numbers, and whichever number is less, you multiply that by 3.8%, and you pay that tax. Now, this was termed a Medicare surtax, but it really has nothing to do with Medicare. It does not go into the Medicare fund. It is simply a separate tax to pay for the Obamacare changes. One thing that's sort of, I won't say it was humorous, but when Obamacare was passed in 2010, we started getting an email chain that was going around to a lot of our clients. I know it came to me a couple different times saying that there was going to be a 3.8% excise tax on your home sale. If you sold your home, you're going to have to pay 3.8% to the federal government. That's wrong, but if you had a gain, taxable gain on your home, and you met these criteria, that taxable gain, if it was above the $500,000 gain that you're allowed, and for most of our farmers that probably is not applicable, but if you're in that situation, you would owe an extra 3.8% tax. Now here's some of the strategies that we're recommending to our clients. You know, a lot of our farmers, you know, I'm going to give you an example here. We have a hog farmer that gets starter pigs from from a company that he's a 25% investment in. He doesn't operate in that business. It generates income every year. Under the old tax law, that was a good thing. We called that a pig. It's a passive income generator, and we wanted all of those that we could get. Well, with the new 3.8% tax, if you're above those income thresholds, this is now a bad thing because you're going to pay an extra 3.8%. So what we can do is we can group that passive income generator starter pig operation with the farmer's Schedule F operation, and all of that income is now not passive, not subject to the tax. Another option is to, if you're going to sell your farmland, you know, you may want to consider, and it's still considered to be passive, or, you know, the tax may apply. You can either use an installment sale, or in a lot of cases, using a charitable remainder trust might be something worth doing instead of an installment sale. One thing I don't see enough of our farmers doing is maximizing their pension contribution. That can reduce your adjusted gross income and get you down below that threshold level. For newer farmers or farmers that are looking at restructuring their operation, if you use what we call a manager-managed limited liability company, if we properly structure it and you have the proper facts and circumstances, we can substantially reduce your self-employment tax and completely eliminate the net investment income tax against that farm income, including the rent income from you know, your land. One thing, if you are anticipating selling farmland before you retire and you've been cash renting it, this is a case where you would want to talk this over with your tax advisor, but you may want to consider converting that, you know, maybe doing a crop share or having enough management activity where you're considered to be material participating that you're subject to self-employment tax, and most people do not want to pay self-employment tax, but you may want to convert that to self-employment tax for a year or two, because you can save quite a bit of tax. And let me just give you a quick example. I don't have a slide, but I just want to go over it. I can verbally go over it. Let's say that, you know, you got 1,000 acres of good farm ground in Iowa, Illinois. You know, you inherited from your parents 35 years ago. It had a value of $1,000 an acre. You know, that 1,000 acres, you can now sell it for $15,000 an acre. So you have you have a $14 million gain. If you've been cash renting that ground and you're not considered to be material participating, that $14 million gain is going to be subject to a 20% top tax capital gains rate, most likely, for most of it, or almost all. Plus, you're going to be subject to 3.8% on $14 million. Roughly doing that math in my head, that's about $500,000 of tax. And I think it's a little bit more than $500,000 of tax. And That could have been avoided if you had paid self-employment tax on that, quote, rent income for, let's say, a couple years and converted it into material participating income, and you might have had to pay $10,000 or $15,000 of self-employment tax, but you've eliminated $500,000 of net investment income tax. This is a complicated law. The regulations that came out are, if my memory right, is about 200 pages long, and they're not final yet. So if you are considering selling farmland that you've been renting out, you need to talk it over with your advisor before you sell it, because if you do it wrong, it can cost you $500,000 to maybe $1 million, depending on the size. Okay, next one. Here's something that I always want to reinforce to our farm clients. It's the easiest tax planning method I know. It doesn't hurt them, and it can certainly help them. And for most of our farmers that grow commodities such as wheat, corn, soybeans, sorghum, oats, barley, etc., they can utilize deferred payment contracts, and that's where the farmer has delivered the commodity to the elevator or to Gargill or whoever it is. They've sold it for a price, sometimes not a price, but they've sold it. They've transferred the title to the elevator, but they're not going to collect on that payment or on that contract until the following year. For most farmers, they automatically pick up that income when they receive the cash, but these contracts are considered an installment sale, and a farmer is allowed to elect out of the installment sale method and actually pick up that income in the year that they sell it. And where we like to do this, or where it really comes in handy, let's say we've done our tax planning with the farmer before year end, and we want them to be in that $200,000 of taxable income. Now, remember, these are projections, so now we're doing the tax return, and we found out, oops, instead of having $200,000 of taxable income from the farm, we're at zero or we're at slightly negative, and this causes our farmer to lose the advantage of the 15% tax bracket, causes him not, if he's got qualifying children, not to get the benefit of the qualifying children. He loses the benefit of the standard deduction. So there's lots of reasons why we want to pick that $200,000 number. Well, if the farmer has sold 4 or 5 sets of contracts, let's say he sold one for a couple thousand bushels, one for 5,000 bushels, one for 10,000 bushels, he can pick and choose, or we together can pick and choose enough of those contracts to get him back up to that $200,000 number. The key is this is on a contract-by-contract basis. You can't sit there and say, let's say you had a contract for 5,000 bushels. You can't say, I want to pick up income on 2,000 bushels and not on 3. The other thing that we worry about when we do this with farmers is we want to make sure they properly record the transactions so you don't pick up the income twice in 2014. You know, you've reported in 13, you've collected the cash in 14, that cash is actually non-taxable now. So you just have to make sure that you've reported that correctly in your books. Another thing that I've seen, matter of fact, I worked with a farmer in Nebraska a while back, and I saw his deferred payment contracts. All they were was an email from the elevator saying, okay, you've sold our grain to us at $7, we'll pay you in January of the following year. Technically, that's not a valid deferred payment contract. Or an IRS agent easily could argue that's not valid. Okay. Section 179 and bonus depreciation, we've had really in a way no changes other than the fact that nobody expected it to be this way. Section 179 is $500,000 for this year. However, if Congress doesn't get their act together and their history over the last 6 months or more is not that good, it drops all the way down to $25,000. $25,000 gets you about, what, 3 rows or 4 rows of a 12-row corn head. It doesn't get you much. The nice thing about Section 179, it applies to new and used equipment. However, the life of the asset has to have a 15-year life or less, so farm buildings do not qualify. And this is something we need to reinforce to our farm clients out there that have fiscal years. They've invested in an S corporation. They've invested in a partnership that's got a fiscal year, let's say a November 30th fiscal year. Section 179, unlike bonus depreciation, is based on a fiscal year beginning in 2013. That tax return won't be filed until after November 30th, 2014. And you have to be careful, because if that partnership kicks out $500,000 of Section 179 to two partners, so they're each getting $250,000, and if the law in 2014 is only $25,000, each partner is going to lose $225,000, and that's a permanent, it just poofs, it disappears, so that isn't something that you want to do. Bonus depreciation, nice thing, they kept it at 50%. This, again, this is all new farm assets, has to be placed in service before December 31, 2013. The nice thing about this feature is it applies, like I said, to all farm assets. That includes your machine shop, your hay shed, any farm building is going to qualify for bonus depreciation as long as it's finished, placed in service by the end of this year. And we've had a lot of farmers, you know, they've built a pretty nice machine shed. You know, it's been pretty easy to spend $400,000, $500,000, $600,000 on a nice machine shed over the last few years, and that's automatically 50, or in a couple of years it was 100% deductible. That's been a nice feature for our farmers. Here's my equipment strategies. If you need to upgrade equipment, buy it this year, because we don't know what Section 179 is going to be next year. And again, I want to underline the word if you need. You know, it isn't if you want, it's if you need. Definitely buy it this year. You can elect out a bonus depreciation. So if you're like a lot of our farmers, they have completely depreciated every single piece of equipment and asset they've purchased over the last 5 years. They're not going to have any depreciation deductions to offset income in 2014, 15, and 16. So you may want to elect out of bonus depreciation or not take Section 179 and spread it out over the next 5 or 7 years. And, you know, when we're doing tax projections, even cash flow projections for our farmers, you know, if we're doing a good job, we're actually projecting out at least 3 years. You know, too many cases we get locked into wanting to eliminate taxes for the current year. You know, we might save $25,000 in 2013, and then in 2014 or 15 we realize we cost ourselves $75,000. So it's important to make sure that you stretch this out over a 3-year period. Farm income averaging, especially important this year. If you're in the highest income tax bracket, you know, you're over that $450,000 of taxable income, you want to make sure that you use farm income averaging this year, even if it doesn't save you money this year, and I can guarantee it will save you money this year. But if it doesn't save you money this year and you're going to be in that higher tax bracket for the next 3 or 4 years, if you make the proper election on on farm income averaging, you can easily save $30,000, $50,000. But if you don't make the proper election, you're never going to save the money. I mean, we've had too many farm clients that we've picked up as a new farm client, or we've been reviewing a farmer's tax return, you know, and let's say for 3 years in a row they showed 0 income. And then in that 4th year, they had, let's say, $500,000 of income. And we look at page 2 of the tax return, and it's being prepared usually using the tax rates in effect for that year. Well, doing an amended return, like in that case, $500,000 might save $50,000 or $75,000 because they get to spread it out over that 4-year period. So you got to be careful. You want to review your prior tax returns. You may need to amend some returns to get the proper income averaging base year amounts. Okay, we're getting toward the end here. I know everybody is probably tired of listening to me talk, but I think we're down to the last 3 or 4 slides. Crop insurance. Last year, almost all, I won't say all, but almost all of the crop insurance proceeds last year, especially for the corn and bean farmers, really related to yield. The spring price was much less than the fall price. The fall price determines whether it's related to price. In that case, there really wasn't any price loss. It was all yield loss. If they had the proper circumstances, they could defer that crop insurance into the next year, which we'll go over here on the next slide or two. This year, I'm going to say it's the opposite. Most of the claims will be related to price. You know, 565 in spring. I can't remember the final number for October, but I think it was about 435, 440, 430, somewhere in there. You know, that $1.20, $1.30 drop is going to result in a lot of price claims, but, you know, a lot of the yields that we're hearing out there are higher than their APH. Now, there's going to be some, like in, let's say, western Iowa and Minnesota and so on, that might be the opposite, but most of them are going to be price claims. So let's just quickly go over that. If it's a claim that you receive due to a price claim, none of that can be deferred. You have to report it all in 2013. However, if you do want to get it in 2014 and you can work it out with your crop insurance agent and whoever's paying the claim, if you receive it in 2014, it's not taxable until 2014, even though the claim was in 2013. That assumes that you're a cash method farmer. Yield loss. Yield loss claims can be deferred to 2014. If you're a cash method farmer, claim is received in the year of loss, so you got to receive it this year. If you receive it next year, you can't defer it. And here's the kicker. Your normal business practice as a farmer is to report more than 50% of your crop sales in the year after harvest. So if your normal practice is take advantage of those deferred payment contracts or wait until after year end to price your crop and to move your crop, then you can go ahead and defer it if you want to. Now the key is normal business practice is sort of a nebulous, you know, there's been some court cases on this, but it's sort of a nebulous term. If over a 10-year period, if you normally report more than 50% in, let's say at least 7, I'd want to see 8 or 9, but at least 7 years, you're probably going to be okay to defer. If you're reporting it in 5 years out of 10, I wouldn't say that's your normal. So you have to be careful on that. And then again, if you want to defer it to next year, just make sure you receive your claim next year. Okay. Now again, a lot of our claims this year will have components of both. They'll have both a price claim and a yield claim. You have to, this is a term that us tax guys like to use, it's called bifurcate. You basically split your claim between a price claim and a yield loss claim, and whatever that price claim is, you have to go ahead and report in the yield claim. If you qualify under these rules, you can defer that. Usually your crop insurance agent can tell you right away how much of the claim is related to price and how much is related to yield. University of Illinois has a couple things on the internet from last year and year before on how to calculate that. I think Iowa State has some. We've had some with our blog and on the AgWeb blog. I know we've posted that last year. And another thing you got to be careful of is when the crop insurance claim is paid to you, a lot of times they'll net the premium out, the next year's premium. So let's say you have a claim of $400,000, your premium is $100,000, so you get a check from the insurance company for $300,000, but when you get the 1099 from them, they're showing $400,000. That's how much we have to report on the tax return. And if you simply look at your check register and only pick up the payments you've paid in cash, you're going to forget, or we're going to miss the fact that you can deduct that $100,000 of crop insurance premium. So be careful to reconcile your 1099 to your checks. I think we're down to the last slide, and then we'll have time for questions. I can see it's we got about 10 minutes to go. Just quickly, estate planning update. Lifetime exemption for gifting and or what your value is when you pass away. is in 2013 it's $5.25 million. On Halloween, I think that's memory, on Halloween it actually got bumped up next year by $90,000. It's now $5.34 million. Your annual gifting amount that you give away without having to file a return still remains at $14,000. You know, a lot of our farmers, you know, when farmland's going to go for $12,000 or $15,000, the state law allows them to reduce this based on what's called special use valuation. However, there's a limit as to how far you can reduce your estate. This year it's $1,070,000. Next year it jumps up to $1,090,000. And this hasn't been tested yet. We're not sure what it is, but this may be a strategy for later on. You may want to review your options on using the special use valuation in the first estate, even though it doesn't reduce your tax, but it maximizes the portability that can go to the surviving spouse. Again, that's something you'd want to review with your estate tax advisor, your succession tax advisor, and so on. And I think, yep, thank you. That's the end of my presentation. Now we're ready for some questions. Hopefully we got some questions. Otherwise, definitely thank you for your time. And again, just briefly, I'll touch base. You know, I do the blog on AgWeb called the Ask the Farm CPA or the Farm CPA. I'm pretty sure there's a spot on there to send me an email. But if you don't want to go there and you want to write down my email, I'll give it to you right now. It's paul.neiffer, so Neiffer, @CLAconnect.com. And Julie, I'm ready for questions.
All right, thanks, Paul. Appreciate it. I'm looking at the chat box and I don't see any questions. So I think if people want to go ahead and type anything in, I'll read them out. But I think you've done a fantastic job of taking an extremely technical and complex subject and making it easily understandable for us.
Okay.
Thank you for your time. Really appreciate you sharing this information. And
okay.
To our participants, if you've found this presentation to be helpful, I'd encourage you to check out and register for the Executive Women in Agriculture Conference, which will be held December 5th through the 6th in Chicago. You can find more information about it at www.execwomeninag.com. On behalf of our top producer team, thanks for joining us. Hope you have a great Friday.